We're live. Hey, what do you know? I don't know. This thing maybe is working. I'm not sure. But either way, welcome, Swiss Gold Global, independent business owners, to the network marketing training number 182 on this Wisdom Website Wednesday, September 9th, 2015. Apologize for the whatever the heck's going on here this morning, but I don't know if it's my computer or Google or what, but this is just a freaking mess of a nightmare. Over 30 minutes to get this thing set up this morning. It just makes no sense whatsoever doing who knows what or why. So anyway, regardless of all that, let's get this thing kicked off here. And let's see if I can just get one last piece to the puzzle in place. And there we go. Boom. All right. Let's see here. Website Wednesday. Sorry, this thing's got me all screwed up. I don't even have a website up because I literally just got this thing going, and I don't even know if it's going to continue to go. So let's see what if I can potentially bring up the website even. I don't like doing this. I was trying to be all set up here so I could be, in place and ready to go. But what I want to talk about this morning is, in the website, we've been talking about the Real Wealth Revolution, and we've looked at some of the stuff by Philip Judge, a very interesting man who has got posted in the, what are you doing over here? Who's got posted in our website some very, very interesting information. And today, I think I also, not quite sure if I looked at the other gentleman's stuff. Yeah, I think we did. I don't know. But either way, this morning I looked at Jim Rickards. And this thing is just not, I'm sorry. I don't know, like I said, I don't know if it's the computer or Google or what, but I just hope this is actually happening. Okay. Jim Rickards, in the Real Wealth Revolution section of our website, in your back office, in your, in the Real Wealth Revolution section, which is the educational part of the website. Jim Rickards is a New York Times bestselling author, chief global strategist for West Shore Funds, is a former general counsel of long-term capital management, a consultant to U.S. intelligence community and the Department of Defense, and an advisory board member of the Physical Gold Fund. And these trainings in here, these interviews, these talks being held by John Ward and interviewing Jim Rickards on specific subjects. This latest one that was in there, I believe, is from about June. Oh, looks like the website might be up. It's from about June, I think 14th or 15th of this year. And it starts off talking about the recent that was actually going on, I think, as this interview was taking place. Speech delivered by Janet Yellen of the Federal Reserve. Okay, and here we go. I am actually in. I'm not sharing right now, but I just want to at least be giving you the proper information here. 1 second, I'm right there. Yeah, okay. June 2015 is when this was recorded. Subject was bond markets in trouble as China rises. They begin, as I mentioned, talking about the address given by Janet Yellen, the chairman of the Federal Reserve, the woman who replaced Ben Bernanke some time ago. And what she was talking about in the beginning was, the decisions to raise interest rates. And, the Federal Reserve is who basically is in charge of that, who has that authority in this country, who is in charge of what interest rates are doing, is all handled by the Federal Reserve. And basically, what Jim was pointing out here is that going into 2015, the Federal Reserve had speculated that sometime in March or June they would be raising interest rates. And there were, obviously a lot of different people and organizations, et cetera, and so on, who were, on board with these ideas to one side or the other. There was a bunch of March people and a bunch of June people, and this was recorded in June 15th, and basically he's saying, well, March has come and gone, and June has now pretty much come and gone, and interest rates have not been raised at all, and slight fluctuations, but nothing to speak of. And so and he was saying, hey, back when, and I'm not sure exactly when he was originally talking about this, but he says, I said then, and I still say now, that they will not be raising rates in 2015. And in this speech now, they're saying that, okay, now, March is come and gone, June is come and gone, and here we go, now it's going to be September or October or possibly December that we're going to be raising the interest rates. And like I said, Jim still holds fast that 2015, no interest rates will be raised. All right. The funny thing here is that, the Fed, well, in this speech, basically, I'm going to actually just skip forward a second. In this speech, Janet Yellen actually, pretty much gave us the Fed's playbook as to when and why they would see the ability to raise interest rates. And basically what they said was that, when we have 2% inflation and we have 5% unemployment and we have 2.5% growth in this country, that's when interest rates will be raised. And then they also said that, hold the phone here, we also have to, be forward thinking and stay ahead of the curve. So, okay, so in Jim's mind, all right, so that's what they're looking for. So there's going to be, a period of time when if we see if we see 2 or 3 of these factors trending in this direction, take off 2% and let's call it 1.8% inflation, with that rising, obviously, 5.2% unemployment with that declining, obviously, and 2.2% growth with that also rising. If 2 or 3 of those elements can be trending in those directions and hit these trigger marks, boom, that's when they'll start raising interest rates. Well, it ain't happening. Okay, we're not there. And basically, the Fed has told us also too that, they base their decisions, all their decisions are data based. And obviously that's where we just pointed out, these specific numbers, this data pointing to these specific numbers is when we'll raise rates, right? The Fed has always been, strongly proponing that they are data based, but hey, the data stinks. And and the Fed agrees that the data stinks, but they have these forecasting formulas which say that things will get better. So they continue to lead the markets to believe that they're going to be able to raise the rates. And I mean, I don't know. I'm listening to this, and I'm at this point in time, I'm starting to chuckle, and then he goes on to say that and then the Fed has the absolute worst forecasting history of anything you can possibly think of, and not only are they always wrong, they're always freaking drastically wrong. I mean, they're freaking way off. Their forecasts make no sense whatsoever. And now, I mean, I'm rolling in the aisle now thinking, okay, I mean, you think about that, they're telling us right now, we're based on data. We will take action based on the data. But we have a forecasting formula, and this is what the forecasting formula says. So we're going to be able to raise rates what come this time because things are getting better. But then, and they're selling this to the different markets, you know, the stock market, the bond market, the real estate market, all these markets. They're selling this sort of interest rates are going to be coming up. We're going to be able to raise interest rates, you know, at this point in time. And they sell this idea out there and they get them all to buy in and believe, and then nothing happens. And they really want the best of both worlds. They want to be, you know, they want to talk rate increase, but do nothing. So I don't know. I just found that sort of very fascinating and ridiculous at the same time. And then, so the next thing he gets into is the bond markets, and you know, what's the deal here? But what he talks about basically is that there is a lack of liquidity in the bond markets. And what does he mean by a lack of liquidity is, you know, a lack of actual, you know, backing of money within the bond market. It's all on paper, so to speak. And, you know, the way that what bonds are for is, you know, for the government to be able to print money, basically, to, you know, control the money that's out there. And so, you know, they buy bonds when it comes time to, you know, increase the money supply. And the government will buy bonds with pretty much invisible made up money. And then they'll sell bonds at, you know, when they want to decrease the supply. And some of this invisible made up money gets taken out of the marketplace. In the old days, there were bond dealers, actual people, companies, organizations, whatever, who would, you know, be basically kind of brokers of these bonds. They would buy and sell bonds for their clients, from clients and for clients, you know, buying from and selling for. And so these guys would actually have their own money in the marketplace. That doesn't exist anymore. And this is where the liquidity is gone. Those bond dealers aren't there anymore. The trading rooms are empty because it's automated now, and it's all in, you know, the system, so to speak, and it's all being run by certain algorithms and everything else within the, you know, the computers. And so basically what you have happening today, and what we, you know, basically kind of seen recently, is that, you know, one certain trigger will, within, you know, all of these automated computer systems algorithms, one certain trigger happening in one place can set off another trigger in another place, and then that in conjunction can set off another trigger in another place, and then now all of a sudden these three triggers together set off another trigger which looks like something, you know, bigger than what actually happened in the first place. And all of a sudden now you've got this big major activity happening, all because of these triggers that have been triggered by another trigger within the automated system. And now you've got, you know, the whole market swinging from one side to the other, or back to this side, or however the thing goes. And it's creating these, what he called flash crashes. And he compared a flash crash to being in an airplane at, you know, 20,000 feet and hitting an air pocket, or, you know, some turbulence or whatever, and the plane dropping, you know, 2,000 feet in an instant, and everybody, you know, who's not seat belted up, you know, bashing their heads on the ceiling, and there's going to be some collateral damage. You know, people are going to get hurt, and in these flash crashes, what we're going to start seeing here is that, you know, it may not be visible to the public, but there's going to be, you know, I mean, obviously, you know, when a plane does that, and a lot of people on the plane, there's going to be a lot of injuries. A lot of people are going to get hurt. A lot of bystanders, a lot of investors who have their money, you know, in what they feel are safe places that are, you know, working the bond market, are going to be hurt. But then there's also going to be coming up, you know, in these flash crashes soon, because they're going to be, you know, maybe bigger or however. I'm not exactly sure exactly why he got into all that, but within these flash crashes, you could be seeing, you know, you could be seeing one or more firms actually going down, being carted off the field and never returning. So if a whole firm goes down, how many investors is that going to affect? And if you have one or two firms that are actually, you know, being taken out of the market, that they're so deeply invested in something the wrong way, and they just get completely wiped out. How is that going to be affecting people? So that's going to be something huge looking forward in the bond markets, is these flash crashes sort of thing. And so what he's talking about here is the fact that you have these, basically your bond investments are now a digital asset. And here's an interesting thing that they were talking about, that I guess they're talking about the invasion of cyberspace by someone, purportedly China, and strongly believing that China and Russia have been behind some of these sort of um, what do they call, hackings of the United States, of federal employees' information. And he was saying, I mean, the whole thing here is it's not necessarily all about, I mean, it's not necessarily even about acquiring individuals' pertinent information for, the purpose of stealing credit card information and all of that. It's more so, I mean, stealing real-time technology and software and information like that. And the very interesting thing he was talking about is with these digital assets and cyberspace, and the bond market being sort of in the digital cyber arena now, that your assets could be wiped out by a hack from, literally, not from an individual hacker is looking to steal, but from another country, that could pretty much just wipe you out overnight. So that's pretty scary to be wiped out overnight like that. Let's see here, gold. And the final thing that he was talking about here, he just kind of made mention of this a little bit, because he was talking about how he's a big proponent of gold, but and he tells his clients that they should be in gold, but it's not like sell all your bonds and get into gold. There's a very legitimate segment of your portfolio that should be in tangible assets, and gold being one of those tangible assets. And Jim says 10%. Some people say 20%. So somewhere in that range, 10 to 20% is probably really your gold investment portion of your portfolio that you should have. But he says once you start talking about gold and then mentioning the G word, you start getting tagged as a gold bug or all this stuff. And the funny thing about gold is that he was saying that it's not so much that and they were asking, oh, I know the question was about gold confiscation potentially happening in the future. And he was saying that here in America, not that it's not going to happen, not that it couldn't happen, not that it wouldn't happen, but it's not a high percentage scenario, because realistically, worldwide, the U.S. citizens don't have that much gold holdings, so it's not that big of a deal compared to back in the day when we did it before, when gold was, I mean, people actually carried gold around in their pocket and used it to make purchases. Gold was a big part of the money flow and of the economic structure of the country. And in today's world, as he was saying here, is the gold holdings of the U.S. public isn't that big. So I mean, there's not a monstrous gain to be made by in instituting gold confiscation here in America. However, if it does come down, what are they going to do? Go knocking on people's doors and flipping over their mattresses to see how much gold they got under the bed? But one place that is very simple for them to be able to go and, confiscate your gold is going to be, and, they're going to have full cooperation, because obviously they have full cooperation of the government right now for anything they want to do, is the banks. So I mean, if the government says, hey, you guys can't have gold anymore, we're going to come take all your gold, obviously going to be very simple for them to, walk into every bank across the country next Tuesday and have every safety deposit box opened up and, scoop out all the gold. So that's one thing where, having your gold assets, your gold and silver assets stored in, private storage is definitely a huge factor. And now here's the thing in my mind. They didn't get into this. This just came into my mind actually. Is okay, great, private storage, but all right, if the government is going out and confiscating gold, what's to say they can't basically pretty much shut down private gold storage and walk into the private storage facilities and just go confiscate that gold too. So, private storage here in America is, to me, a big question mark. Local private storage here in America, I don't know if there even is any, but that's something that I would be seriously leery about, which therefore led back to the whole thing that we actually kind of were talking about the other day with the new material that was downloaded by, I think that was in the Philip Judge area, on the security of private storage in Switzerland. And even Jim Rickard got into talking about some of the same things about the solidity of Switzerland and how strong that little country in the middle of Europe, and you would think Switzerland, you would think it'd be up by Sweden and Norway, but it's in the middle of Europe. Look at a map. It's in the middle of Europe, surrounded by, countries like France and Spain, I don't know, but all these countries around Switzerland, Luxembourg, but that is, it's such a stronghold in that geographical location. It's really amazing. And even Jim was talking about how, even some of the private storage facilities in Switzerland are, have been dug into one of the Swiss Alps somewhere. So your gold is stored deep inside one of the Swiss Alps somewhere potentially, and how they have just such an infrastructure of defense in that country throughout, tunnels and caves and I mean, what they've done over there as far as digging up those mountains, it's pretty crazy to think about. So the information that Jim Rickards delivers, that's a little tidbit. That's just one. That's the most recent uploading. I believe there's probably one coming here very soon, because I know I haven't had a chance to look at it yet, but I just recently got an email with some new information that Jim had put out, and that could be an offshoot of what's going to be on the MP3 downloadable listening audio training within our real wealth revolution portion of our Swissco Global website back office access. And so like I said, I have a feeling that there's some new material that's about to be loaded up in there. This was the latest from June of 2015. Then there's one from March. I'm just going to go backwards. May 2015, we had subject Middle East, Ukraine crisis and global economy. Okay, that sounds pretty interesting. February of 2015, we had Swiss franc, euro, ECB, quantitative easing, and the Ukraine. Okay, very interesting subjects there. Back to January of 2015, we had what happens if the Federal Reserve raises rates. Okay, bingo, there you go. Let's go back to January, see what we were talking about as far as raising rates and compare that to what was said in June. Very interesting. That's what I'm going to do for next Wednesday. December 2014, subject QE, quantitative easing, and estimation for gold is higher than 5K an ounce. And that's December of 2014. And now I go back all the way to June of 2014, and here we have one subject: gold, $7,000 an ounce in 3 to 5 years. So there's another little comparison project of those two talks to see how they go. So, like I said, very, very pertinent, up to date, worldwide economy information in here that you're not getting anywhere else. You don't hear this stuff on the news. When did you hear about what exactly is the Fed's modus operandi for raising rates? Where'd you hear that? Who told you that? Nobody told you that. You just got it right here. Okay, you can have it within your website at the tip of your fingertips. take a look at wealthhealth.swissquoteglobal.com. And with that, I am done here. I am way over time. I got to get over here to my next hangout. If you're interested in wholesale real estate, jump over to Sell a House Arizona. Look for that, wholesale real estate. And this is us saying goodbye for Website Wednesday. We'll be back here on Freedom Friday and Oh Universe. I ask not for more riches, but for more wisdom with which to make better use of the riches given to me at birth, consisting of the power to control and direct my own mind to whatever end I might desire. Everybody have a great day, and we will see you on Freedom Friday.